So, what do you think is the single biggest investing mistake you could possibly make? Most people assume it's picking the totally wrong stock or maybe having the terrible luck of buying at the exact top of the market right before a massive crash. But the data and the stories we're going to look at today reveal something completely different. The absolute biggest error. It isn't mathematical at all, it's mental. It's the paralyzing, stubborn belief that it is simply too late for you to start. Listen, if you're sitting there nervous about making a wrong move, let me just stop you right there and level the playing field for a second. Mistakes are just a part of the game. Even legendary titan of industry figures like Warren Buffett, Bill Ackman, and Benjamin Graham, yeah, they all made catastrophic, multi-million-dollar errors. You absolutely do not have to be perfect to build wealth. Welcome to this explainer on the investor's life cycle, surviving the biggest mistakes. Today, we're going to synthesize hard mathematical realities with some pretty fascinating insider anecdotes from top fund managers and financial educators. As you'll see, we're going to prove that investing mistakes are deeply human, entirely avoidable, and most importantly, highly survivable. Okay, let's dive right into this. Here is our chronological journey, which pretty much mirrors a typical investor's financial life. We're going to start with the cost of waiting, then move into investing without a plan, navigate the market timing trap, tackle emotional sabotage, and finally, discuss knowing exactly when to exit. Number 1, the cost of waiting, overcoming the mental hurdles of starting late. Let's talk about the exact fear that keeps millions of people completely frozen on the sidelines. Take the story of a woman named Gloria. She started investing at age 53. Not 20, not 30, 53 years old with practically nothing saved up. Everyone told her she'd completely missed the boat, that the magical window for compound interest was permanently shut. But 12 years later, at age 65, her portfolio had grown by over 850% from her initial contributions. The belief that you absolutely must start in your 20s is just mathematically wrong, and honestly, it becomes this self-fulfilling prophecy that just keeps people broke. Here's the thing. Older investors actually have concrete mathematical advantages. You have tools that a 25-year-old literally doesn't have access to. Step 1, use your catch-up contributions. By 2026, if you are 50 or older, the tax code actually lets you contribute up to $32,500 a year to a 401k. Step 2, claim your full employer match. That is quite literally free money. Don't leave it on the table. And step 3, automate your savings. Look, as your income grows, it is so incredibly easy to fall victim to lifestyle creep. Automating your investments straight out of your paycheck ensures that you are prioritizing your future without even having to consciously think about it every single month. Moving on to number 2, investing without a plan, building the foundation of strategy and risk. So, the absolute biggest mistake beginners make once they finally do start is just throwing money at random funds without figuring out their long-term goals first. Your goals have to dictate your strategy. Humphrey Yang's risk and age matrix brilliantly illustrates this. Let's walk through it. If you are young, meaning under 35, and aggressive, you have the time horizon to go 100% into ETFs or even individual stocks. But if you're older, nearing retirement, and you're conservative, your priority totally shifts to capital preservation. In that case, you might want a split of something like 20% stocks and 80% bonds. You have to align your asset allocation with your specific time horizon, or you're going to end up taking on risks you really aren't prepared for. Now, part of building that rock-solid plan is understanding diversification. And honestly, we've got two completely opposite expert philosophies to look at here. Kevin O'Leary prefers a very passive approach. He says you should never own more than 5% in any one name to protect against volatility. On the flip side, Warren Buffett, an incredibly active stock picker, argues that diversification is just protection against ignorance for folks who can't analyze businesses. So what's the takeaway for us? Your level of diversification absolutely must be tailored to you. If you're a passive investor, spread that risk out. But if you're an active investor who's actually willing to do the deep research, you can afford to concentrate your bets. Section 3. The market timing trap. The dangers of waiting for a dip. This right here is where people try to get clever and outsmart the market by hoarding cash. I want to share a pretty painful anecdote from a full-time trader named Amir. He was holding around 40,000 ringgit in cash, just completely sitting on the sidelines because he felt the economy looked shaky and a major crash was imminent. So he waited. And waited. But guess what? The big crash never came. Instead, by keeping his cash totally idle, he missed out on a massive 36% run-up in the S&P 500. Guys, even seasoned professionals cannot time the market reliably. Sitting in cash waiting for that perfect entry point, it is an incredibly costly illusion.
And look, when market crashes do actually happen, chasing performance instead of staying diversified is going to destroy your portfolio. Just look at the COVID-19 crash. Investors who chased hot tech stocks and the NASDAQ 100 Tech Sector Index suffered a brutal 45% drawdown from the peak. Meanwhile, an investor holding a globally diversified all-equity ETF experienced a much more manageable 20% drop. To put that into perspective, this completely grounds the abstract concept of risk in hard, undeniable numbers. Chasing whatever sector is the hottest right now inevitably leads to buying high and panic selling low. Number 4, emotional sabotage. Navigating the psychological warfare of investing.
So even if your math is completely flawless, your brain is absolutely going to try and trick you. Let's rapidly cover 3 psychological traps that snare even the most seasoned pros out there. First up is ego. This is holding onto a losing investment just to avoid admitting defeat. Think of billionaire Bill Ackman stubbornly holding onto a massive short position against Herbalife for years, literally just because he'd publicly committed to it on television. Next is the availability heuristic, which means making a purchase based on a past success that looks kind of similar. Warren Buffett bought Dexter's shoe because he'd had previous success with shoe companies, totally ignoring that Dexter lacked a competitive moat. It was a massive blunder. And finally, borrowed conviction. That's investing in a stock simply because someone you admire did. If you don't understand the underlying business yourself, you are not going to have the conviction to hold it when the market gets turbulent.
So, the golden rule here? Do not let the stock price dictate your emotions. Focus entirely on the actual business and its earnings power. Former fund manager Drew Cohen suggests this brilliant mental exercise to help out with this. Close your eyes and ask yourself, if this stock drops 50% tomorrow, how am I going to react? The key is to prepare for the drop mentally before it actually happens, so you know whether the business is genuinely failing or if the market is just having a temporary panic attack.
Which brings us to our final section, number 5, knowing when to exit. The hardest part of the investor life cycle. This is arguably the absolute hardest part of the investor life cycle, balancing when to cut your losses and when to let your winners run. Let's tackle cutting losses first. I really love this concept. It's called the law of holes. It simply states, if you find yourself in one, stop digging. Back in 1880, legendary author Mark Twain invested in a new typesetting machine. The venture quickly turned disastrous, but Twain, he just kept pouring money into it, even promising to pay $7,000 a year until it finally turned a profit. He completely succumbed to sunk costs. You absolutely must have an exit strategy determined beforehand, so you know exactly when to admit defeat and stop digging your hole any deeper. But on the flip side, selling your winners way too early, that can sting even worse. Take an analyst from the Motley Fool who bought Chipotle stock. He watched his investment gain 100%, he doubled his money, and he happily sold. Now that sounds like a massive win, right? Well, he anchored his emotions to that initial double and completely failed to see the company's compounding future. After he sold, the stock exploded another 593%. He missed every single percentage point of that massive run-up. So how in the world do you avoid selling a great company way too soon? Drew Cohen uses a fantastic rule he calls the Godfather offer. This is a stock valuation so ludicrously expensive that you can sell a great compounding company without having to even think twice about it. His rule is super simple. Unless the market is offering you a price that literally defies mathematical reality, a true Godfather offer, you should generally avoid selling fundamentally great businesses. Just sit on your hands and let compound interest do the heavy lifting for you. And that brings us to the end of our explainer. I want to leave you with a final, provocative question to help you reflect on your own financial journey. What is the single biggest trap you need to step over today? Are you borrowing conviction from some influencer online? Are you sitting in a pile of cash waiting for a magical market dip that might never come? Or maybe, just maybe, you're letting the fear that it's too late paralyze you into doing absolutely nothing. As we've seen, the data proves these mistakes are all completely survivable. The only true error is letting fear stop you from playing the game at all. Start planning, step over the trap, and I'll see you in the next explainer.